Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, September 16th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. Please do your own due diligence. It's your money. It's your responsibility. Okay, so it's inevitable, I'm going to talk about uranium. So this is a daily chart off of stockcharts.com for the uranium stock ETF from Sprott, URNM, the symbol. And as you can see, since at least for the last, I don't know, month and a half, 2 months, we've kind of broken out to the upside. And things have went kind of parabolic in the last week, coming off the conference, the WNA conference in London, and some of the news that came out of there from various folks that attended. And we'll get into that a little bit later. But as you can see, we've talked about this before over the last several weeks. There's been a lot of interest in uranium again. And I found it interesting. I was listening to someone, I don't recall who it was a podcast or a short clip from a video. And somebody said, no, it was the Harris Kupperman and Mike Alkin discussion that they had at the WNA conference, which I will post a link to. You'll have to go to the Praetorian Capital website to watch it. But regardless, this is about an hour-long video. Two of the guys that obviously Mike Alkin has been going to these conferences for a while. And it's mostly, the nuclear industry insiders. There's not a lot of finance people there. And one of the things that he said was, how can you have not made money in this industry, in this, and there are people that write me and say that they're down, that they have lost money. We're in a bull market in uranium. I don't understand that's possible. And the only way that's possible is falling into the trap that I think some folks are going to fall into right here. You see the spike in the price of URNM. Obviously, the constituents of it are the various uranium mining stocks. And so people start chasing the shiny object. People that don't understand the thesis, they just heard a podcast, the juices start flowing, visions of sugar plums and early retirement pop into their head, and they rush in and start buying these stocks, market orders. We get to where we're at now, which is tremendously overbought. Very possible that we're going to see a pullback in the next couple of weeks in these stocks. Nothing goes straight up, and then the people become disenchanted. Some of these stocks have been up 50, 100% in the last month. And so that gets the animal spirits going. That attracts the tourist trade, if you will. And us locals, us that have been involved with this for years, that understand the long-term thesis and have bought our shares substantially less, yes, this has been a good week to watch your brokerage account go up in value. But what happens is a lot of new people come in, they buy here, this thing drops next week or the next couple weeks, they get disillusioned and sell. Okay, and then you don't see them again until the next time, and they're constantly buying at the top and selling at the bottom. That's how people have not made money in these businesses, because again, they fall into that chasing shining objects. So don't do that. If you're listening to this video and this is the first time that you've ever heard about uranium or the potential, and you're going to get, wow, this really has a lot of potential. You're going to start watching a bunch of videos and listening to podcasts and get all jazzed up. Don't rush in and shoot your wad. This going to take some time. It's taken time, and take your time getting into this. Understand what we're talking about. Understand the thesis. That gives you the conviction. For the last year and a half, nothing happened except for the stocks drifted lower, even though the fundamentals of the business got better. And yet people, they go on to the next thing because they get bored. They have to be doing something. Okay, you should have been accumulating these stocks as the price was going down, especially if the fundamentals were getting better. If the fundamentals of your business are getting better, say you owned a business, this is how you have to approach this. This is the one of the main problems, not the main, but one of the main problems people do. These are businesses. This is an industry. You're investing in businesses. That's how you have to look at it. If you want to flip baseball cards or Pokemon cards or whatever, that's not investing. That's speculating. So if you're coming into this, you're just getting into this, you're just hearing about it, don't rush out and shoot your wad right at the top when everything's overbought. When you're this far above the moving averages, you don't want to shoot your wad, because this is likely going to pull back. The moving averages need a chance to catch up, and then we'll have the next push higher. That's not to say that the price won't go higher, that somebody will come in and, but we're into that mode that I'm starting to remember from the last uranium bull market, where we just kept seeing, oh, the spot price is up $1. The spot price is up $2. The spot price is up 50 cents. It just kept happening every week. And eventually it builds momentum into a, big blow off top as retail pours in at the very end. So I don't think this is the end yet. We have a while to go, but I'm very, very optimistic. I mean, the last 3 or 4 weeks of my reporting, because this has been the focus, because there's been so much action, but don't confuse newsworthiness, attention with, you got to run over there now. Okay, that's not investing. There's still a lot of upside in this. You can make the case that, I've said we're going to see new all-time inflation adjusted highs. That's probably $200 a pound. Is that, that's where I think we could see that or higher. But I don't know if that's going to happen in a week or, 5 years from now. No one does. No one knows if it'll reach that high. So be careful, be prudent, and don't get overexcited. This is play the long game. But regardless, this has been a very good week, and this is what we want to see. And you've seen it on volume. Volume's been building, and this is the ETF. This is like one of the main ETFs. So a lot of the juniors have done much better than even this, but you'll see similar chart patterns. And so I would expect a pullback over some period of time, and then a resumption moving higher. So we'll see. Again, this is the same thing. This is the Sprott Physical Trust. This is what's been driving things. There hasn't been a lot of action in this. The trust really hasn't been doing much buying lately because the net asset value was lower than the price, or vice versa. The price was lower than the net asset value, which was a bargain. And they don't really add pounds unless the price gets positive to the net asset value. Then they issue shares, which they did do this week. I don't know if they bought any uranium. Suffice to say, though, that this is just a reflection of what's happening in the price of uranium. And again, this is broken out. You see the volume. You see the positive moving averages, the 50-day trading above the 200-day. Things are starting to turn up. So it's the same thing, right? I mean, basically, most people should just be buying this trust and putting it away but people want that added juice from those equities. So, I think that's why I tell a lot of people URNM, the previous chart, is probably a good thing, because it's market cap based. You're going to get a lot of the large companies like Cameco, Kazatomprom, and you're going to get a lot of physical uranium via this physical trust and like Yellowcake. So you can go look at the holdings yourself and see what's appropriate for you if you're inclined to participate in this uranium bull market. But we're definitely, when we see these kind of breaks higher, I think we're off to the races. So, and we'll get into why that is. Again, here's uranium price futures. I mean, this is showing 65. I've saw spot prices at 62 and change. So, how anybody, if you go back and look at a long-term chart, you could have bought, for example, for somebody to say, well, how are you making money in this? If you just would have bought the trust back in the lows of the post-pandemic crash in 2020, say March, I think March 2020 is when the trust bottomed around 625 a share, and you're up to 22. This is an intraday chart. So you've 3.5 bagged it in 3 years. So what other things do you have in your portfolio? If you're up 3.5 times in 3 years, you're crushing Warren Buffett. Okay, you're crushing the best investors in the world, and all you had to do is buy the physical trust at the bottom. Now, how many people did that? Probably not many. Was I buying? Yes, I was buying then. This is, because I understood that what the thesis was. I've understood for 5, 6, 7 years that this wasn't going to go away. This was going to be nuclear was going to become a focal point for many people, especially as it's now becoming understood that unless you want to choke on coal particulate matter and you want to do something about CO2, then nuclear is what you need to do. We're not going to do it with just rebuildables by themselves. And we've talked about that before. We don't need to get into that again. But, if you just would have known that and bought at the bottom, which was possible, people did it, I did it. There were several, we've been talking about this for 5, 6, 7 years, and people pointed that out on Twitter. All you have to do is, what do you do when you have a thesis that the fundamentals continue to get better? Well, any opportunity to buy cheaply, you should be buying, and then you just sit and hold. And that's the hardest part. That's why people are not successful. They, first of all, don't have the conviction. They don't understand the thesis. They haven't done the work. And then they can't hold. They can't just sit and, accumulate capital from their W-2 or their side hustle or their business. And then when they are presented with an opportunity like the COVID pandemic and prices came down massively for all assets, to step in and buy because the world wasn't going to end. And so there's been opportunities along the way. And what happens is, as I said earlier on the last slide, people will come in now because they just can't help it, right? They get just like somebody, threw cayenne pepper up their backside, and they got to do something. I got to do something. I got to get in. I got to get a position. Okay, that's not how you should be thinking about this. Give it a chance. I mean, this is the kind of stuff when you have these kind of gaps up and this kind of move. Not to say it couldn't keep gapping up, but this is way overbought. If I didn't have a position, I wouldn't be putting new capital right now. I would wait for a pullback. I'm not saying necessarily the trust will pull back, but let it, let's see what happens. So this is, I believe, from Goring and Rosenzweig. Yeah. So I'll put a link to a blog post they had that referenced their latest quarterly 40-page report where they talked about uranium. Just a few points here that if you're new to this, you need to keep in mind. Most people that have been around this trade, around this theme, already know this stuff, but I thought this was instructive to go over. Uranium structural deficit has accelerated dramatically since 2021. Reactor demand bottomed in 2020 at 161 million pounds and is expected to reach 188 million pounds this year. So people said that nuclear was, I remember when I was talking about this 5 years ago, people said, why are you doing this? Nuclear is a dying industry. Okay. Wrong. Primary uranium production remained depressed through 2022 at 120 million pounds, a multi-decade low. So we have increasing demand, a growing demand for uranium, and we have production remaining depressed. In fact, at a multi-decade low. Secondary supply averaged only 22 million pounds, leaving a deficit of nearly 30 million pounds in 2021 and 2022. A new source of demand burst onto the scene in 2021 as well. The financial buyer, led by the Sprott Physical Uranium Trust, a financial vehicle, or financial vehicles have acquired between 25 and 30 million pounds each year in 2021 and 2022. And there's actually additional physical funds coming. We have the Sprott Trust, Yellow Cake over in trades in London, and there's a certificate type program in Zurich now. And I've heard that there's probably 2 or 3 other funds. And obviously, with all the hedgies now, especially with all the news around this and the things starting to move, you can rest assured that people will create additional vehicles to buy physical uranium. This is what happens. Okay. As a result, the uranium market experienced a deficit of nearly 180 million pounds between 2020 and 2023. The deficit was met by materially depleting the commercial inventories that had accumulated following the Fukushima disaster. By the end of this year, we expect commercial inventories will be back to 250 million pounds, covering reactor demand by less than 18 months. The last time commercial inventories reached these levels in the mid-2000s, prices spiked to their all-time high at $145 per pound. And Gordon Rosenzweig concludes by saying, we expect the same now. And so do we. Actually, I expect a higher price. And with all the financialization, we didn't have the same amount of social media frenzy that can be developed around a theme. I expect things are going to super spike. People talk crazy. You know, we saw met coal last year go to $400 a ton, right? It's pulled back. So why couldn't uranium go, you know? Again, you know, people say, well, it can't happen, but yes, it can, because it's impossible. If you listen to the interview with Kuppy and Mike Alkin, the fuel buyers really do not pay it. They're not inclined to think as we do as investors. And they just assume that at some price, the fuel will be available, the uranium will be available. Now, again, there's no shortage of uranium in the ground. We're not going to run out of uranium. But again, as you just said, you know, as I've pointed out ad nauseum on this channel, every week I keep bringing up, you know, every time people are putting reactors online, like I said, follow John Quakes on Twitter and you'll get all the news. Every time a new reactor, a new extension, whatever is happening, but I don't hear anybody new mines starting. Yes, we have a few that are going to be reactivated, but we don't have the big rush into building new mines. That will come at a higher price, whatever that incentive price is, but that hasn't been reached. And even when we do reach it, it will take years for the mines to be built. And yet I think that we are on the cusp. You know, we didn't have this type of demand situation during the last bull market. Nobody was building reactors back then. Okay. We didn't have these type of supply deficits, you know, that don't look to be able to be covered. Okay. So it's similar in some ways, but different in many others. And so again, I'll put a link to this article. You can read it. It actually goes through all of the summaries of basically the previous moves in uranium. You can read if you're so inclined. I would want to understand what drives this market in previous bull markets, and they kind of go through that. So these guys are tremendous resource for learning, and I would avail myself of that if I were you. So this is, I'll put a link. Kuppy wrote a Kuppy's Corner blog post about what he saw at the WNA. And then, like I said, he had an interview about an hour long where he talked with Mike Alkin right there in the lobby, I guess, of the meeting convention center or wherever they were, hotel or whatever. It was kind of funny watching like them kind of be like a little bit, not saying looking over their shoulder, but they were like saying stuff about the fuel buyers and stuff, acknowledging that they're very smart, but they just don't get it. They don't get what's happening in this in the fuel market, in the uranium market, and they're oblivious to it. And why? I mean, after you watch this, I mean, if you don't get it by then, what's happening or what's going to happen, I mean, you're not going to get it. I mean, what you can see is like the excitement is really building, these two guys, you know, and how they play off each other. But regardless, what I like about the blog post that Kuppy wrote in particular was how he kind of was analogous to The Big Short. And if you're not familiar with that movie, The Big Short, talking about what happened with those guys that scored big on shorting mortgages, it was kind of a similar situation. You had these financial outsiders that saw a situation that the people in the industry didn't see. The fact that, you know, as they said in many times in that movie, or many people in, you know, Why are you betting against housing? Housing never goes down. It's never went down. Well, it did. And a select few people saw it and profited enormously from that. And again, if you haven't read the book or if you haven't watched the movie, I encourage you to do that, because then you'll have a better understanding of what Kuppy's talking about, because he makes direct references to it. Anyways, I pulled a few vignettes, a few things from his blog post. He's talking about this conference, WNA conference. Said it felt like I was attending the bigger short conference. Out of approximately 750 industry attendees, maybe a dozen of us got the joke, and we were all finance guys. The industry guys seemed oblivious to the potential squeeze on supply, talking about uranium supply. Just like there had never been a nationwide housing crash during the area of securitizations, there had never been a structural deficit in the lives of these attendees. So they don't have a reference point. He goes on to say, I thought that the trade was mostly about Sprott taking advantage of a small deficit to corner the market, talking about the Sprott Uranium Trust buying physical uranium and hoovering it up. If you remember his previous writings on this, he thought it would be akin to when the Grayscale Bitcoin Trust was hoovering up Bitcoin. He thought that would be the impetus or the catalyst to really get this thing going. So he changes lanes here. He changes his thinking. He says, now with my estimates showing deficits running at nearly 1 million pounds a week in 2024, Sprott is barely even a rounding error to overall balances. Rather, the trade is about the fact that an industry cannot function for long when deficits are running at a third of total supply. Goes on to say, there were hardly any finance guys, no bankers, and certainly no booth babes. Just a few oddballs like myself who don't understand how the deficits can stay this large for years into the future without an accident. The fact that no one seemed to care sure got me excited. He sums it up by saying, let's just say I'm far more bullish today than I was last week before the conference. So again, I'll put a link to this blog post, a link to the interview if you haven't seen it already, and I encourage you to watch it. And of course, some other folks that are pretty tuned up on uranium have been out on Twitter with their takes. Overall, it's very bullish. So again, we've been in this for a long time. We've bought our positions very, very lower levels. I will continue to add if there's any opportunity on the upside. I was adding, over the last year and a half as everybody, gave up, slowly chipping away, dollar cost averaging. That's what you do in a bull market. And we're going to get paid now. And I was really enjoyable the last couple weeks seeing what can happen when the juices start flowing, when the price of uranium starts moving, and what can happen to the uranium stocks. Again, we're probably overbought in the near term, but this bull market's not over. And so what's funny is this is what you see, right? This is an announcement I saw on Twitter. This is BlackRock. It says another ETF that will buy uranium stock. So it's not specific to uranium, but you'll get the point. This is BlackRock offering. It's the iShares S&P TSX Energy Transition Materials Index ETF. It gives you exposure to North American listed equities, providing access to a range of critical materials necessary for the global energy transition. Targeted access to companies engaging in the mining, exploration, or manufacturing of products using aluminum, bauxite, cobalt, copper, lithium, manganese, molybdenum, nickel, palladium, platinum, rare earth metals, silver, uranium, and zinc. If you go and look, which I put this slide together yesterday, Thursday, actually. I'm actually doing this on Friday, but Cameco's the largest holding. It's 10% of the fund. Now, I don't know how big the fund is. I'm not saying this is going to change anything. What I'm trying to show you is that interest is building. This is what happens. The flywheel effect, if you will, as Justin Hume discusses, okay? So this is what we like to see. Now, what we will see at the end of this thing will be uranium will be on CNBC every day. There'll be 1,000 uranium juniors on the venture exchange. There'll be multiple of these funds. It'll be all over the place. It'll be so obvious, but I don't think we're anywhere near that yet. But we'll have to wait and see. So shifting to oil, we haven't forgot about oil. WTI closed above $90 a barrel this week. I think, the Saudi-led voluntary cuts, the OPEC plus cuts are biting into inventories. Inventories are declining. I have a chart from Eric Nuttall. I'll show that in a couple slides. But as long as inventories are declining, prices are going to go up. And how high they can go, I don't know. But we do know that the Saudis extended the cuts into the end of the year. So we're getting, we're leaving summer, entering fall. As the heating season comes, we'll see what happens. But a lot of folks are now saying, $100 a barrel is not out of the question. We shall see. This is from, I think this is a Reuters article. Anyways, it says at the start of the year, Wall Street luminaries and no, this is a Bloomberg article, sorry. At the start of the year, Wall Street luminaries and oil trading giants had predicted a rebound to triple digits, only to back away when China's economic recovery disappointed. I was in that camp. Okay. I thought China was going to propel us. And then I thought that we would see a slowdown in the US, and that would kind of like hold prices from, cracking 100. But I did think that the Chinese recovery was going to really lift prices, but be tempered by recessions in the US and Western Europe. Didn't quite work out that way. But with Saudi Arabia and its ally Russia tightening the screws on supply and demand, hitting new records, Brent crude has rocketed to a 10-month high above 92. As RBC Capital Markets says, the next round number is within striking distance, talking about $100. Meanwhile, OPEC itself, for all its claims of seeking balance, is projecting an even bigger supply shortage, with inventories set to drain by an eye-watering 3.3 million barrels a day next quarter. That would be the biggest deficit in at least a decade. If they hold to this and we see 3.3 million barrel per day supply shrinkage, that would be over the next 3 months, 100 million, close to 100 million barrels a day. We'll definitely be over $100 a barrel. And if we're not in a recession, you have to start thinking what oil price level pushes us into a recession. Is this it? What's gasoline going to be? We're going into an election year, and Mr. Biden already played the SPR card. What bag of tricks does he have next? And again, I'm not going to get into why I think this is happening. I think it has to do with the rearrangement of the global chessboard. We've talked about that a little bit in the past. Don't have time to get into that now further, but we will. And, we're going into election year with a person that nobody in the U.S. likes and nobody overseas likes. So there's not going to be any favors done for Mr. Biden and the Democrats by OPEC or anybody, or by Russia. Squeezing the U.S. and the Europeans. I mean, the global South and East now, it's interesting. I will mention one situation as it regards to this deal and what's happened. What I think is happening is to squeeze, when you're talking about war, the view, I think, by the neocons in the West, and especially by the leadership in Ukraine, is totaler Kampf, total war. And so if you're going to approach it that way, they're not going to, there's been no bending on the requirements for Ukraine to talk to Russia. Russia needs to completely leave these occupied areas. Or I don't see that happening now, because the Russian constitutional law is those 4 provinces are now part of the Russian Federation. They just had elections again there in these places. They're not going anywhere. And I think, as part of a war effort, total war, totaler Kampf, as the Germans would say, it encompasses economics. It encompasses geopolitics. Okay. And if the West isn't ready to come to the table, then I think that some people are going to help them get motivated. And losing the election next year over $5, $6 gasoline will certainly motivate people. I mean, they're looking for an off-ramp to get this done. So I think that has a lot of the motivation here. We'll see what happens. Maybe there'll be cheating, maybe there'll be whatever. We'll have to see. But I think that we're looking good with a lot of the oil stocks and oil services stocks. I did a recent interview with Ladislas Maurice of the Wandering Investor, where I talked about, it's a short interview, 15, 20 minutes, just talking about why I'm so bullish on oil field services, in particular offshore oil field services. And I think that will give you kind of talk about why I'm so bullish on that. So we'll have to see what happens. Like I said, you got to keep I've said this many times, as it relates to the oil market and energy markets in general, you really got to pay attention to what's going on, because things constantly are changing and new information comes in, and you have to reprocess it and to make sure that your ideas are correct. And if they're not, then you have to be willing to change them. As I said, I thought things would turn out differently this year. I thought we would see, $100 a barrel because of the Chinese rebound. It didn't happen that way, but this works too. As long, if we get to $100 a barrel, I'd be satisfied with this. And to this point, my expectation of a recession in the U.S. hasn't materialized. So at some point, they're going to have to revisit that in the next quarter if employment stays strong and the economy doesn't crack. So again, no one, when you're out there, doing forecasting or trying to come up with probabilities, again, based on what cards you're dealt, you're going to have a different set of probabilities. So here's a tweet from Eric Nuttall. He's talking about, he's always putting these charts out about global inventories. I guess I haven't really listened to him recently. For some reason, he hasn't been showing up on my feed. But anyway, this tweet says, this is like from September 11th, says global oil inventories are now at their lowest levels since Kepler data begins. That's 2017. And we believe will end 2023, 2024 at a 300 to 78 million barrel deficit relative to 2017, 2019 baseline. So you can just look at this. You can see this is where we're at now, this vertical blue dotted line, and this is where the forecast is if things maintain. I think you could say that the oil price will be inversely correlated to these inventory moves if they in fact materialize as forecasted. It goes on to say, this would strongly suggest a higher oil price. Yet at the current price, many stocks trade at 15% free cash flow yields. We remain bullish, exclamation point. He had another chart, which is interesting. It says, I put on here, capital flows continue to ignore energy. This is the cumulative global sector fund flows going back to September 22. You see energies down here and technologies here. If the energy prices continue to do what they're doing, I suspect that this is going to start moving higher, the energy. The generalist investor still isn't back. He's not attracted to these free cash flow yields. Again, if you go and look at some of these, like I said, I think I said this last week, we have a stock in the AIA portfolio that we bought a long time ago. It's a heavy oil producer in Canada. It's focused its cash flow. It came out with a very shareholder positive capital return policy over a year ago, and they've held to it. They said if we lowered our debt by X amount, we would return 25% of free cash flow to shareholders via dividends and buybacks. When we got the next threshold was 50% of their debt cut, and then they would return a certain amount. And now they're to the point, if they get the debt down to a certain level, which I expect him to achieve early next year, 100% of free cash flow will be returned to shareholders via dividends and buybacks. So if the general public doesn't want to buy the stocks, then the companies have been incentivized and are in fact buying back their own shares. They'll just buy their own shares. So I think eventually you will see capital come in as long as these free cash flow yields stay where they're at. this is so far out of whack that it just can't. I think you can't make the case that this is like an alligator jaw that's going to slam shut, right? How much further can the alligator open its mouth? How much higher can technology go relative to all these other stocks, and especially energy? I mean, energy is so far undervalued relative to even the rest of the market, not even talking about just the technology sector. So any way you want to frame it, contrarian, fundamental, what have you, I think that, your risk reward is definitely skewed towards energy. And unless we see, I think we have to revisit what's going to happen after the OPEC plus cuts expire in the end of the fourth quarter. What's the price then? If the price is $125, $130 a barrel, I have no idea what it will be. Does that curtail demand? Okay, we don't know. If they bring on 3 million barrels when the cuts expire, what does that do to the price? So a lot of things in motion again, but I think that a lot of these companies now don't have any debt or have very little debt. They've restructured their businesses. A lot of companies are not out there drilling and spending a lot of money on new capital projects. They're just doing maintenance capital because, as we've said before, a lot of the incentive now is to pay down debt and return capital to shareholders. That's how managements are rewarded. So again, you don't need $80, $90 a barrel to do well. Maybe you only need $65 a barrel. So we'll see what happens. Again, we have to keep our finger on the pulse and evaluate information as it comes in. So here's just a slide from a recent conference, super cycle thesis finding strength. This is a super cycle. What we're talking about is offshore services, and just a few items on here. You can see to the right, the E&P spending 2023 estimated offshore to surpass 2019. You see that shallow water's down, but you see ultra deep water and deep water increasing. Okay. And you're just seeing slowly but surely this increasing over time. So what are the fundamentals? Multi-year underinvestment, energy security and diversification, vital affordable energy carrier through the energy transition. Finite supply side, okay? Activity picking up in most segments and regions, overcapacity dwindling in all segments, new capacity off the table. We've talked about that several times. Again, I think I mentioned it in the interview with Ladislaus, Wandering Investor, that quoted the Seadrill CEO. He said in a recent interview, the Seadrill CEO, that they keep a baseball bat around the office, and if anybody even mentions the word new build, they smack him in the head with it. Obviously, being facetious, but making the point that new capacity is off the table. Why? Day rates, duration, financing, and yards, things we've talked about. Already attractive economics, day rates and backlog with strong growth. Valuation attractive on steel and near-term earnings. Strong discipline, a key feature in the market. So super profit potential. 2004 to 2014 upcycle with super profit for most segments. However, massive new build orders and capacity additions then. Today, capital returns focus, massive dividend potential. And I would suggest share buybacks. So we're already seeing that. We have several offshore themed companies in the AIA portfolio. They're up massively. What am I seeing? Same thing that we've seen in a lot of the oil producers over time. Excess cash flow being diverted to debt reduction, dividends, and share buybacks. So I expect offshore to run neck and neck with uranium. Obviously, I feel uranium now is kind of moved ahead. I had offshore ahead for a while over the last year as potential return, but it looks like now uranium may be edging ahead. But I like both horses. It looks like regardless, I got a Quinella box going on. It doesn't matter which one finishes first or second. I'm still going to make out. So that's where a lot of our emphasis is, and I feel pretty good about both sectors still. I wanted to point this out. I have to ask the question, if commodities bottom, this is the last year. This is the daily chart of the Goldman Sachs commodity index. This is all commodities. And look what's happened since, basically the end of June. Is anybody really paying attention to this? Has anybody mentioned this? You have a 50-day moving average now crossing the basically bottoming. It looks like 200-day moving average. If you go out further on a weekly chart and go back, 5-10 years, you can see also a correction in the last bull run off the COVID lows, and then again a pullback of a year and a half or so, and now it looks like a reacceleration possibly is happening. And why would that happen? Well, again, we go back to liquidity and sentiment drives markets. And what am I seeing? Now, I'm going to get some grief for this, but I'm just going to go ahead and say it anyways. I've mentioned before, as I became more and more, as I've become more and more attuned to liquidity and central bank action. Jeremy Grantham said it's kind of simple. When interest rates go down, asset prices have a tendency to go up. And when interest rates go up, asset prices have a tendency to go down. That's simplifying things, obviously, but that's what he said. And so I started, looking at, there's various websites out there that track every single central bank action in the world. And so I just went back to 2023, and basically I put together this little chart that I just keep updating. And what I wanted to point out is, each month I count up the amount of central banks that have raised rates and the amount that have cut, and then their difference. And then I just made it additive to kind of try to give like a advanced decline line, if you will. I did go back in time because I'm lazy, but I'm just trying to catch this cycle and just see. I probably have to go back and build out the data set to see if there's better correlation with certain assets. But regardless, what we are starting to see is, as you see, is, throughout 2023, this is worldwide, we've just seen every month more and more central banks raising rates than cutting rates, right? You see that January there were 13 central banks. The difference was 13 banks raising. February 18, March it was 23. You could see. But what I started to notice here is, as we got into the summer, it looks like it peaked, and we're seeing more banks now starting to cut rates relative to those that are raising rates still. And so what I'm saying is, are we getting close to the end of a of the rate raising cycle to fight the post-pandemic inflation? And I'm suggesting yes, we are. Now, September, I'm just showing what's happened up to the 15th today. Obviously, this isn't the end of the month, so it could change drastically. But what I'm showing already is it looks like we've already had 6 central banks this month cut rates and 3 raise. Okay. And so have we peaked? Has the rate raising cycle peaked? I'm suggesting it has. I've been looking for this. And now it's a matter to see how this is going to affect asset prices. What I have been noticing as I've looked at this is something interesting. And I think I've mentioned this before. A lot of the central banks in the emerging markets and frontier markets were some of the first to begin raising rates during the inflation that happened during the pandemic or post-pandemic lockdowns. They were on the forefront, and now these central banks are on the forefront of cutting rates. For example, I've talked about Brazil. There's some legitimate actual central banks in Latin America, like Chile, Brazil, Mexico, and they're cutting rates. They were some of the first banks to raise rates, okay? And this kind of ties into what I've talked about before, that I think that, part of these banks that have cut rates already this month have been some emerging markets. Some of the banks that raised rates this month so far were Russia, raised 1%, the EU, and Denmark. But the rest of these were emerging markets. So I find this interesting. I'm not ready to definitively say something one way or another, but again, I think that we may have reached the top of the rate raising cycle, and now we're going to get into a rate cutting cycle. And if that's the case, the emerging markets are going to be on the forefront of that. Yes, there's going to be some, eventually the United States and the EU will cut rates too. But again, we're seeing some leading like I said, the countries that were on the forefront of raising rates are already on the forefront of cutting rates. So this will continue to be monitored, but I'm wondering if it's playing into this, because this looks like the bottom was around June, July. And when did we start seeing this really shifting, where these banks, the difference in banks raising rates vis-a-vis those cutting rates seem to peak around that same. Not suggesting that one is affecting that's a direct correlation. I don't know, but I'm just pointing it out. It's a potential relationship. Cutting rates typically, is going to juice these economies, raising the financial markets, raising getting economic activity to quicken, and that's going to increase commodity demand. That's a very broad brush I just laid out there, and a lot of people are going to scoff and say that's a bridge too far, but this is how my thinking is starting to at least initially develop. So I wanted to point out a clown world before we leave. The coalition in Germany is very interesting in the government as it deindustrializes. There's no referendum or vote on this. Green Party's just kind of doing this. And one of the coalition partners is the finance minister, Christian Lindner. I believe he's from he's from another party that's in the coalition. I forget what the name of it is. Anyways, he's pushing back on the green agenda, and he's basically saying, he's kind of picked up on the vibe that I've talked about. What will change people's views on these ridiculous governments that are just doing things that are, detrimental to the majority of the people in their population? And it's going to be a radical backlash. They call it right wing. I say it's more populist, but this is what the German finance minister said. He said German Finance Minister Christian Lindner slammed politicians in Brussels for seeking to enact stricter clean energy rules for buildings, warning that such plans could spark a dangerous voter backlash and fuel the rise of the far right. Speaking to Politico during an interview in the garden of the finance ministry in Berlin on Monday, Lindner argued that Europeans are suffering from overregulation or, quote, red tape all over the place, unquote. He goes on to say, quote, I think the EU buildings plan is enormously dangerous, unquote. Lindner said. The directive, he added, could endanger social peace because people might get the impression that the policy makes it harder for them to live in their own homes and be able to pay for it. You think? I'm really interested in what's going to happen this winter in the EU. They got off the hook last year with their dumb decisions and blowing up their pipelines to their major energy supplier because they had a mild winter. If you're in Europe, pray for a warm winter. Okay, that's it for us this week. A little bit shorter than usual, but I wanted to get this out. I'm publishing it on Friday. I have stuff to do this weekend. So that's it for this week. Thank you for the continued support. Obviously, we're talking a lot about uranium. That should also be an indication to you that you probably, if you don't own your positions already, not to go running into a burning building and get singed up. There's going to be pullbacks. There's going to be an opportunity. But again, the news continues to get better, and we're extremely bullish over the long term. All right, that's it. We'll talk to you next week.